and it's very, very late for you, thanks for tuning in. For those of you in my side of the world, maybe you're enjoying lunch while you listen to me. So bon appetit, I guess. But yeah, thanks for tuning in. I'm doing small talk for 2 seconds while everybody tunes in, but I see a bunch of people here. I checked the live stream on YouTube, which is happening too. Hello to the YouTube people. I'm looking at both chats on the Zoom webinar and on the YouTube thing, so I'll be catching up with all of you through the whole thing. I'm gonna get started. Let's not delay this anymore. Let's get to it. So let me share my screen and we'll be on. All right, just a quick sanity check. Let me know if you can see my screen in the chat and on YouTube, and that way I'll get started. Cool. So welcome, everyone. We're going to talk a little bit about financial modeling today. And I actually have learned to hate the word financial modeling a little bit, because what startups are usually after, what startups usually need, or like the immediate need for founders, usually gets called a different name. It usually gets called like your investor asking you for a pro forma template, or for a budgeting sheet, or for a revenue estimation. And all of those things are solved with the financial model. But financial model is just like this mouthful of a thing that just in and of itself, it's complicated it scares people away just by the name of it. But here's what we're going to talk about today. So we're going to find common problems with financial modeling, the stuff that we see in the pitch decks that we work with. A lot of the issues we find are associated or tied to financial modeling issues, or they just reveal that something didn't work out with the financial model. So we want to talk about that a little bit. I don't think we've created this approach. We didn't reinvent the wheel, but we're sort of trying to kind of bring awareness to what we call driver-based financial modeling, where we don't just assume that there's going to be growth. We actually find the root cause behind it. And I think that by doing it this way, we solve a bunch of problems around the pitch deck that we often see. So we'll talk a little bit about that. And then the cool thing is, and we used to call this a circus act, is we're actually going to model one of your companies. So for people on the Zoom webinar, we're going to take one of your businesses and model it away, from building what we call a financial model map. You'll see what that is in a sec, to actually building some of that functionality into a spreadsheet and then running a few assumptions. So if you want to be part of that, if you're on the YouTube stream, fine, you can stay there. But if you want to tune in through the webinar, we're going to pick someone at random from the people on the webinar. And then last but not least, associated to that, we'll actually run some revenue projections and scenarios on the model that we'll create for you. And for that, I'll turn to a little survey, and we can do this in the chat. Just type it in both chats, the live chat on YouTube and the chat on Zoom webinar. What is your company about? How would you classify your company? If you were to think of, maybe let's think of these categories: e-commerce, SaaS, marketplaces, either one-sided or two-sided marketplaces, and maybe web. Sorry, not web. Web's too generic. Maybe kind of like mobile apps. Let's say it's the fourth category. So again, categories: SaaS, e-commerce, mobile apps, or marketplaces. Which one does your company fall into? I'm looking at both the chat and both chats. Let me know, and we'll hopefully pick a company in the group that is more useful to most of you guys. I see a lot of SaaS, Jacque's SaaS, Maral, Shakira on mobile apps. Okay, I got an idea. All right. So the only reason why we started doing this and why we know anything about financial modeling is because Slidebean has existed for over 10 years now, and we've helped companies raise a lot of money, a few hundreds of millions of dollars, either with our pitch decks, with our pitch deck design or writing, or with our financial models more recently. And then the most common problems that we see on these pitch decks first revolves around the round size being a completely arbitrary number. Just saying, hey, we're raising $1 million, but not putting any thought behind that number, not enough budgeting, not enough understanding of where that funding gets them to. Another super common problem is the growth assumptions just assume that the company is going to grow 10% month over month, but they don't really understand what is the driver of that. And then a lot of companies that are focusing on raising money to last for 18 months, when in reality, they should be raising money to last till the next round of funding. So you don't, this is very, very key. You don't raise money to launch a product. You don't raise money for a certain amount of time. You raise money to reach the next fundable milestone. So if you're a pre-seed company, you're building your first product, the money that you raise must last until you get to a seed round. What's a seed round? It's a company that has revenue, that has it's a company that has launched a product, that has revenue and happy customers, maybe operating in the $20,000, $30,000 of worth of monthly revenue. That's what you call a solid seed company. So again, if you raise money as a pre-seed company and the money doesn't last to get there, you might get stuck in this sort of like middle catch-22 gray area where you've already raised pre-seed money. Nobody wants to give you pre-seed money twice. And you're not yet a seed company, so you might struggle to talk and find investors in that space. So you don't want to get stuck there, and you want to make sure that your budget gets you there. This absolutely happened to us, and I'm speaking a little bit from experience, where we raised the seed round, and the money that we raised was not enough to get our company to Series A, and we got stuck in the middle and had to struggle to survive, and did, but it wasn't the easiest. Okay, so the solution to all of this is a spreadsheet in the end. There are tools out there. I'm still a big believer in spreadsheets. So we've created a bunch of templates for a bunch of different companies. I mean, our blank template is free. We're going to paste the link in a sec. But we're not going to talk about this template yet, because before we even touch a spreadsheet, we need to understand a very, very basic key concept, which is what is the driver of your revenue and what are the drivers of your expenses. So imagine that we've agreed that you're raising money to reach a certain milestone, right? That may be a round of funding, it may be a revenue goal, it may be exiting your business, becoming profitable, right? So getting there is affected by mainly two variables, which is how much revenue you make and how much you spend, right? But the question is, what are the drivers of your revenue? What's going to cause your revenue to grow? Is it just going to happen magically? Is it going to be based on traffic? Is it marketing? What are you doing? And then what is the driver of your expenses? For example, if you're assuming that your revenue is going to grow based on your expenses, on your marketing, for example, then that marketing must be accounted for, and your cost of acquisition must be accounted for in order to understand where that's going. I'll get there in a sec. But let me give you this very, very classic story of a founder I've seen a million times. Founder comes in, their pitch deck says something along the lines of, hey, we're going to launch, and the first month we're going to start with generating 700 orders. And then that number of orders is going to grow every month, 10% every month, and then for 2 years. And then after 2 years, it's not going to be 10% anymore. It's going to be 5%. But that's overall what we expect is going to happen. And we'll take a percentage of that and use it for marketing. The way that financial model looks like, or the way that budget looks like on a spreadsheet, first of all, is very easy. You just take the 700 orders, multiply it by 110%, and that's that, right? And if you were to draw that in a chart, it would make for a very, very beautiful hockey stick, fast growth chart that you often find on pitch decks. But this chart usually usually means a red flag, because what this chart is showing is that somebody didn't do their numbers. Somebody didn't run the math behind it to understand what was the driver of those orders. So hockey stick charts, unless they're historical, they're usually not a great signal. Okay, so let's fix this, right? How do we fix this? The first question is, well, what is the driver of orders? What's going to cause those orders to come to our platform? And I'm using orders as an example, but orders may mean traffic, that may mean subscriptions, or monthly active users, or the number of drivers/writers in your platform. Orders is a currency based on each different business. And then another important question is, what do these orders drive, right? So the more orders we have, what are we going to have to spend extra? Those may be fulfillment costs or hosting costs or your account managers or your support team, right? So the more people you have on your platform, the bigger your staff around certain area will be, or the bigger your expenses around certain area will be. So what this is telling us is that there's something that drives the orders, therefore the revenue, and then there's something that the orders drive, which are our expenses or our costs. So let's abstract that into a very, very simple visual diagram that could look something like this, right? So we have revenue at the core of it, and then and then revenue has a cause and effect situation going to COGS. So COGS is the first of only two technical terms I'll mention, accounting terms. So COGS stands for cost of goods sold, which is essentially everything that is based on revenue, right? So if you're an e-commerce platform, your costs are going to be and you're selling t-shirts, your costs are going to be the cost of the t-shirts, the cost of the shipment, the cost of the boxes, right? That's your costs. And of course, the more revenue you make, the more costs you have. So a very basic metric for any business is your margin, which is just what percentage of your revenue you retain after you extract your costs. But then more importantly for today's point is, what is the driver of your revenue? What causes more revenue in your business, right? And there may be many drivers for costs. I'm sorry, for revenue. One driver could be paid marketing, right? Of course, so maybe you're a self-service platform, maybe it's a subscription, and you're doing paid marketing. So paid marketing could be search ads, could be display ads, could be retargeting ads, could be sponsorships. I would even dare say influencer marketing, if that, which I think definitely applies to many businesses. Influencer marketing is in the end a paid marketing campaign, and you should be able to track its success. Another common big area or big category of drivers of revenue could be outbound sales, right? So if you're an enterprise platform or maybe even just a B2B targeting small businesses, you have a sales team that's either cold emailing, cold calling, or doing business development and attending events. And then in theory, the bigger your sales team, the more sales that you'll generate, right? So those should be tied to each other. They should be associated. Another common driver of growth could be organic traffic, right? So if you're doing a word of mouth, if you're doing a good social media effort, you're expecting some virality out of that. SEO absolutely classifies here. Even referrals, right? As other companies, other customers refer you to them, that's another driver of organic traffic. And I like to keep that into a single organic traffic category. And then another driver could be returning customers, right? So if you subscribe a customer, they're going to pay you every month, and then that's a driver for revenue. You should take it into account. So the most important part of this is these are all drivers of revenue. These could all, if you're successful in these campaigns, in these tactics, in these drivers of growth, you should generate more revenue. But they're not all created equal. Why? Because some of these will cost money to you. I mean, all of them will probably cost money to you. But most importantly, paid marketing and outbound sales, they're absolutely expenses that your company has to make, right? It's either expenses on your ad campaigns or expenses on a sales team. Organic traffic probably requires expenses on an SEO team, but the big difference I like to make is if you're basing your growth on paid marketing and in order to double your revenue, you have to double your marketing, right? With organic traffic, that's not necessarily the case. Maybe you have a really good SEO team, it's a team of 3 people, and that team just consistently is able to hit new keywords, and those keywords stack up and you have more traffic, right? So the amount of traffic that you get is not necessarily tied proportionately to your team, right? Your team may be very effective or very ineffective. But again, the point is that all of these things eventually drive revenue, right? So you have to understand what comes first to understand how much revenue you generate later. Okay, so just some basic, very, very basic color coding that we'll need to understand ourselves in what's coming next is just how we categorize these. So we're always going to have revenue be green, and through all our spreadsheets and through all our templates, revenue is green because that's the color of money. Next up, we're going to have costs, which is cost of goods sold, and we're going to use those as magenta. The next category, big category, is SG&A, which is sales, general, and admin expenses. Some people like to call this OPEX or operational expenses, which is essentially everything else. Most of the drivers of your revenue, like your marketing costs, like your sales team, they will go here. But pretty much everything else, from your utilities to your office costs to your rent, insurance, and all that, usually falls into SG&A. And then a small little category that few companies have to work a lot with is the capital expenditure category, which is expenses cash expenses that translate into assets for the company. For example, if your company goes to buy a new Tesla, this Tesla is not a $40,000 expense to the company. It's rather a purchase of an asset, and you can't just write off the $40,000 as, hey, we have to buy a car. No, that's an asset that the company has. It still has value, so it's classified a little differently, but we're not going to use it today. Okay, and then this not simple, but first look at this is how a financial spreadsheet a financial model map could look like. So what we like to do and what we encourage our companies to do is before getting into a spreadsheet, before getting into forecasting, build this, which we call a financial model map, just to understand how your orders, sort of how your revenue maps, right? What causes your revenue. So let me walk you quickly through this one. This is the model map for an e-commerce platform. Feel free to screenshot this if you want. But what we have here is that there are two drivers to this company growing. One is paid traffic, ads, and then we convert a certain paid traffic, whatever we spend, the dollar amount that we spent, we convert that to orders from new customers via a cost of acquisition, right? So let's say that the cost of acquisition is $100. So for every $100 that we spend, we'll get a new order. And then, in order to get 10 orders, we need to spend 1,000, and that's what it is, right? There's no workaround to that cost of acquisition. And then the advantage, one big advantage of deconstructing your business model like this is that each one of those metrics, right, paid traffic, or what a good average cost of acquisition is, or what an average conversion rate from organic traffic to orders is, those numbers you can probably find online. People are generally open to sharing some of these numbers because they're not trade secrets. They're just references, and they usually fall within a range. So we'll get to that. So, this company grows from paid traffic and organic traffic. Organic traffic converts through a conversion rate. Paid traffic is blue because it's an expense. Organic traffic is white because there is a team associated to it, but it's not direct expense. That gives us orders from new customers, which add up to the final number of orders at the very end. But then some of these new customers that we have become regular customers, right? And they make repeat purchases. So every month we're going to have a certain number of orders from our new conversions and a certain number of orders from our existing customers, which buy at a certain frequency and so on. And that gives us orders. That's the large box on the right, which drives revenue, of course, on average order size. And then for each order, we're going to have fulfillment costs. That's our shipping. And then for the revenue from the order, we're going to have the product cost, right? What's the average margin or markup that we put on products? So that's, in a nutshell, a very, very basic e-commerce platform. Now, judging by the comments, first comment I see question, which is whether this is being recorded. Yes, it is being recorded. It's going to be live on our Startup Club channel forever. So you'll be able to rewatch there. And then the most common question I got was, the most common company type I see is SaaS. Let's actually build a SaaS model. This answers Ron's question on what platform we're using to generate these, because I'm actually going to build one from scratch. So let's, out of the people on the Zoom webinar, why don't you guys raise a hand? Or actually, no, let's do this instead. Type in like a one-liner of what your business does for the SaaS people, because we want to model a SaaS business. I'm going to unshare my screen for a sec, and I'm going to get ready to build one. The platform that we use to do this is Miro, and the template and we have a template with kind of like a few pre-built models, and we have a few pre-built models, and we have kind of like the boxes pre-filled and pre-formatted. So all our financial model template, which is again a free download, we're going to paste it in the in both links here. My team will help with that. Yeah, we have a template that you can duplicate and generate it from here. So okay, guys. Again, for the SaaS people on the Zoom webinar, can you type a one-liner what you do if you want me to build your financial model for you? I see Ali with an ERP for immigration law. I don't know if that exactly fits a subscription. Is it a subscription, Ali? And we'll bring you up, I guess, if that's the case. I see B2B for manufacturing from Yi. See a SaaS HR tool for companies. Yeah, Ali, it sounds like you're in a SaaS. So let me bring you, Ali, up to speak. We'll make you a co-host so that we can see your face, and YouTube will be able to see your face. Just a warning. You'll be streamed live on our channel. And then I have the building blocks here. Let me reshare my screen. Gotcha. I think again for all the other thanks for your answer to everybody else. I think that the the model will apply to many of you because the essence of a SaaS is pretty similar. But let's go. Ali, can you hear me? Can you speak?
Yes, can you hear me?
I got you. Yeah,
All
cool.
right, fabulous.
Here. Hi. All right. So so this is the template that I've now reshared. Please, everyone, confirm in the chat that you can still see my screen. Um, again, we've we've made a few model maps that you can use as a reference, and you can just copy and play with these around. And we have just the building boxes, which I'm going to recycle, just to build Ali's model, just with the same format. Ali, what's your company name?
It's Visa AI with a Z. I can put in the chat as well.
Yep, sure. Yeah, type it in, make sure I get it right. Visa, yeah, I got it. Okay, so what's the model? Who do you sell for? Who do you sell it to?
So basically, our customers are immigration law firms, and I mean the product is going to be like an enterprise resource planning, and it's basically a subscription-based product.
Okay, and you said the customer is what, legal firms?
Yes, well, specifically immigration legal firms,
Okay, so
immigration law
these
firms,
are,
basically.
I'm assuming large. What?
It could be like anything. Could be like a single, attorney to like, yeah, basically large law firms.
Okay, what's let's say what's the first customer that you're going after?
Well, again, like it could be, let's say like the first one could be like just a single immigration, attorney who's basically, doing all the, so I mean, just to explain a little bit about the process, um, when like an attorney takes like a client, they have to go through like a lengthy process that's gonna end up being like the final product of that would be like a 500-page packet for that client, for that immigrant, and which is supposed to be submitted to the USCIS. And some law firms have like a very sophisticated team, like
Hmm?
specific people for doing each task, and some others, I mean, don't have
But
that luxury. So yeah.
Ali, sorry to interrupt, but so your client is the lawyer, and it's usually an individual lawyer.
Oh, either that or the law firm.
Okay.
Um,
But
yeah.
let's just for the sake of time, and
Okay.
honestly, sometimes for the sake of focus on a startup, you usually start with one. So you pick, which are you selling first? Is it to the firm or is it to the individual lawyers? Because the sales cycle is very different for each.
Okay. Let's say the individual attorney.
Okay. And how you're getting in front of them? Are you thinking marketing? Are you thinking sales?
Um, what do you mean?
How are you gonna get in front of them? Are you cold calling them? Are you knocking on their doors? Are you doing a marketing campaign and hoping they
Well,
sign up tomorrow?
the first customer is going to be like based on connections, like the existing connections.
Okay, so you're getting warm intros to them. Is that
Yes. Yes, exactly.
okay? Um, so I'm assuming, I mean, let's say that those are the first 50 customers or maybe the first 100 customers from your
Right.
connections, but the forecast, the idea with the model is let's forecast for the future, right? At scale. So at scale, do you think it's a sales team that's reaching out to them, or do you
Yes.
think you're gonna is that the case? Yeah.
Yes. It's going to be
Okay.
a sales team. Yes.
Okay. So that sounds like an outbound sales team approach. And then the idea here is that at the very core, right, we can have different stages of a sale. We can have lead and qualification and so on. But at the very, very basic, like if we zoomed out all the way, uh, we're gonna have a certain number of sales agents, right, that are gonna drive the number of clients, right? So in essence, and again, at the very zoomed out version, what we have is an outbound sales team that's going to have a new clients per um, agent. Uh, right. So the more agents you have, the more clients you have at least on the individual lawyer side. Okay. And now tell me about the business model. How much are you charging them?
$200 per seat.
Okay. So $200 a month.
Yes.
Okay. Subscription, subscription, subscription. There you go. All subscriptions have a churn rate, so some of those cancel, and we need to be ready for that. But in essence, this is at the very, very basic. This is your SaaS model. So actually, let's actually build this on a sheet. Let me pull up the other. I have another tab. Hold on. Okay, so what we're going to do now is finally, as promised, we're going to move from just the theory and just the visual to the spreadsheet. But then the advantage of first understanding these drivers is that now we can use this as sort of like a map guideline for how we're going to work on the spreadsheet. So I have a template here. Hold on, sorry. Copy. Sorry, just a sec, loading up. And there we go. Okay. So this is a copy of our template. Again, this is a template that my team has. We shared a link to this. So you can all download this for free. It is genuinely free. I'm gonna make this a little bigger. Let me know if this zoom level is enough for you guys to see. Okay, so this is a financial model template, a financial model sheet. Essentially, what the financial model sheet, if we wanted to look at this on a map, is it connects all of these sheets together, right? It connects the SG&A and the costs and the revenue, as we saw before. It connects them all into a main sheet and it just adds them up together. So at the very core, what the template already does is if you go to SG&A and you add, I don't know, marketing expense, I don't know, if you're spending money on HubSpot and it's $99 a month, and I just drag that along and I'm going to say, hey, I'm going to spend $99 a month on HubSpot. What the template does is it just aggregates those, everything that you've added there. It aggregates it to your SG&A, and then that aggregates it to your monthly expenses, and then it aggregates it to your annual expenses, right? So it gives you sort of like a broad summary of all of the expenses and all the revenue that you add. It takes care of doing taxes for you. So if you want to estimate how much you owe in taxes, it also allows you to do that. You can, here in the settings sheet, I'm actually going to take your company name, Ali. So let's do this for Visa AI. Oh, sorry. Here. So let's call this company Visa AI. And just for the simplicity, I'm just going to assume that you operate in USD, but you can change that for any of the models. Okay. So let's actually build this into the sheet. The first thing that we want to estimate is the sales team, right? So in order for Ali to start generating revenue, he'll need to hire a sales team. Ali, when do you expect that sales team will begin to exist?
Like how long? Like you mean?
Yeah. When will you start selling is, I guess, the question.
Oh, let's say within the next 6 months, like after 6 months from now.
6 months from now. Okay. So here I'm just gonna. So we have a staff sheet, and the staff sheet is sort of like a little summary for how we forecast for staff. So let's say that this is, let's call this the scaling sales agents or the outbound sales agents. Okay, do you have a forecast of how much you want to pay these agents? No commitments for everybody watching. It's not an opening yet, but do you have a budget?
I think 50K is reasonable. Let's just keep
Okay.
it there. Yeah.
Yeah, so let's keep an annual salary of 50K. So if it's in the US, and just for the record, normally hiring someone will cost you, some extra taxes on top of that and some, health insurance, etc. So normally a fully insured employee will cost about 24% a month, 24% on top of that, just as a record. So you can add that here. Let's assume that you're gonna increase their salary by something like 3% every year. And then, as Ali mentioned, he's gonna start selling, let's say, in October of this year. So let's add that here, October. Ali, how fast do you expect to scale that team? Say, how many agents are you hiring every quarter?
Let's say two.
Two every quarter. Okay, let's do that. So we'll start in October. In October, we'll hire 2 new sales agents every quarter. And let's maybe cap that at, say, 20, right? So what that's going to do, this little line that we added, I'm going to maybe color it so you all can see it easier. So this is kind of like the role that we've implemented as Ali's main sales team, right? So the way we can see that is we can go to SG&A and we'll see that here our headcount is growing from 2 to 4 to 6, right? Because we're adding 2 new sales agents every quarter starting October. And then, of course, the salaries and the cost of hiring that team is here on payroll, right? So that scales all the way up to when we reach 20, and it keeps scaling with the annual adjustments that we'll make to the team. So what we now have, if you want to look at it, what we have now is this section, right? We've created a driver for our model, which is we have an outbound sales team. We've budgeted how much money they cost. We've budgeted our, the expenses that we have to make to keep that team on payroll. And now let's go into estimating how many clients this team can get. So let's, in order to do that, we're going to work on the revenue sheet. But one good practice is to keep this in the assumption sheet. So let me clean this up. These are just a few links to other templates, so you can use them. But essentially, what we have now is, and I'm going to steal a format from this line just so we can see it. So, new customers per sales agent. I'm going to actually split my screen. So what we're doing here essentially is we've added this expense on the outbound sales side. Now we're writing this arrow, right? So this arrow of how many clients do we convert from outbound sales agents? So Ali, how many new lawyers do you expect each of these sales agents to sign up every month?
Let's say 10.
10. Okay. Okay, so we have that 10. Let's actually build this into a revenue sheet. So on the revenue sheet, very, very simple. All we really need to do is, and this is going to be revenue source 1 probably. So this is going to be, let's call this individual lawyers, individual firms, individual clients, lawyers. Okay. So we're going to have a new clients. So every month, the number of new clients is a very, very, very simple operation. All we really have to do is go to the SG&A, and we're going to take this number, right? The number of outbound sales agents, which we know is scaling every month because we already added that. I'm going to highlight it so you all can see it. So this is the number that we're going to take, and we're going to multiply that by 10. So not rocket science there. Let's take that formula. We'll do number of outbound sales agents times the number of new customers per agent. We want to fix that formula so it references the right cell, and then we'll drag this along. So now we have an estimate of how many new clients we'll bring based on the number of lawyers. More useful and more importantly is if we change the way we scale staff, right? So instead of saying 1 new agent a month, instead of saying 2 agents per quarter, we change that to 1. Or if we cap that at 25, that's going to affect how much revenue we can get, right? Just based on the number of sales agents that we have in charge of that. Okay. So next up, we're going to consider churn rate. So we have new clients. Every month we might lose a few of them. So we'll say lost clients due to churn. And then total clients, total active clients. So the number of total clients, we'll do that one first, is just going to be the sum of the new clients minus the clients that we lost, plus the clients that we had the previous month. I'm using some just out of, just because I'm used to it, but we could just do a simple operation. So this minus this plus this. So that'll give us the total number of active customers. Again, we need to drag this formula first, but yeah, so this, if we drag it on, it's just taking in the total number of clients, right? It's just adding them all up. All now we need to do is add the ones that we assume that we'll lose due to churn. And the ones that we'll lose due to churn is, and we'll need to add that input here. So let's actually build that. Let's call that individual clients. Individual clients. That's like a title. Let's make that green and larger. And then looking at the map again, what we really have is the subscription price and the churn rate. So let's add those. So we'll have the average subscription, which is 200. And we'll have the churn rate, which is the number of customers that we'll lose every month, like the cancellation rate. So let's call this churn rate. Which I'm gonna jump over you, Ali. Like, standard churn rates for individual platforms or individual subscriptions are usually in the 5-ish% range, maybe. That could be a good kind of starting reference. A great platform has a churn rate of 1 or 2%. Platform with a lot of churn is usually in the 10-15%. right? So that's a range. That's no secret, right? It's a pretty standard number in SaaS. So you can reference it if you need to. Okay, so let's do clients due to churn, which is just the clients that we had the previous month times our churn rate. And that'll give us an estimated number of clients that we lose. So let's add that. And then one thing that you'll notice is that the number of clients that we lose have now become a decimal number, which we absolutely don't want. Like we don't want fractional customers. So we'll probably fix that by just rounding the total number of customers at the end. So that way we'll always operate out of a round number of clients. Okay, so now we have these formulas up. Let's drag this along. And this should be done. I think this one gives you an error because it's trying to run an operation with the number sign here. You can fix this very easily by just doing an if error formula. This works in Google Sheets and Excel, which is that if that doesn't work, then just add these two, and that's it. Oops. Let's just get rid of that for now. Trying to making sure that we have time for questions today. Okay, so we're adding that up. Let's just test it, see if it's working. We have 20 customers in October. That's the month when we start hiring the agents, right? So 20 new clients in October. In November, we have 20 new clients, but we lose one due to churn, so we end up with 39. So that seems to be adding up correctly. Great. So now let's turn that into MRR, right? So subscriptions. So we'll have new MRR, lost MRR, and then total MRR. So monthly recurring revenue MRR, which is the standard metric for SaaS. And that's just very, very simple now because all we have to do is take the number of clients and multiply it by our average subscription per client, 200. And then if we drag that along, what we'll have is a total MRR. And that is probably similar to our revenue, right? That's what our revenue looks like. Some customers may pay in advance. We might give them discounts, but overall, those are going to be exceptions rather than the norm. So I missed a few. Let me drag this here. There we go. So our total amount of revenue is probably going to be something really, really close to the MRR, and that's it. So now we have is at the very, very core, at the very, very basic, we've modeled Visa AI, and we can start looking at and drawing some conclusions out of this business. Just to understand if it's viable, right? So the first thing we'll look at is just go on an annual sheet and understand what our revenue looks like from the number of individual clients. It looks like looking at the last year in the model, so we're generating $11 million, and it's costing us $1.8 million to generate that revenue. Most of that is in salaries and the HubSpot expense I added. We're missing things here, right? So we haven't added more costs. And I guess maybe the one I'll ask Ali just to do as references. I'm assuming you're going to use OpenAI or some other API plugin. So do you have a reference of how much that's going to cost in terms of server costs?
Sure, maybe like is that per month or do you want that per month or like?
Yeah. So we could say hosting costs. Let's call that hosting costs. I guess it's based on the number of API requests, but a simple way to do it is say, well, yeah, like each individual customer based on the number of API requests, it's going to cost us about, I don't know, $10 worth of OpenAI fees, right? And this is really a cost. So we can use this color coding just to remember where all of this lands. And then in order to estimate that here in costs, we can say OpenAI, let's assume that you're using that, not a commercial for OpenAI or ChatGPT. Just going to take that and say, well, from the total number of active customers, which is a number that we now have, it's this line here, total number of clients. We're just going to take total number of clients, multiply that by the hosting costs, and that's it. Let's just drag this along. Important reference in the spreadsheet as you guys work on it. Any number on the sheet that's black is a number that we consider a formula result, right? It's the output of something else, right? So this is just the sum of all this. This is just referencing this number. So if the number is black, just assume that's a number that's being affected by something else that's happening on the sheet. Whereas blue numbers are numbers that are pretty much meant for you to change, adjust, and add whatever expense you want. So these are all placeholders that you can change. That's kind of the point. So of course, since this is a formula now, we're just going to turn this row to black format. And here in annual, now we see that we have a cost associated to it and a gross percentage margin. Now, Ali, last question for today. is this platform built? Do you have to build it? Where are you in that process?
Still building the building process.
Okay. Is let me see. I mean, is that team in-house? Are you outsourcing it?
Yes, in-house.
Okay. Let's actually build that team and see what happens. So let's assume, Ali, that you have to in order to launch in October as you're planning to, you have to build that team today. So how big is the team ballpark?
Maybe 10 engineers
10 engineers?
in
Okay.
total.
So let's assume that we have a CTO. I'm not gonna get into salaries because this is a real team, so I don't want to reveal any of their salaries. But yeah, so let's assume that starting now, so starting May, there's a CTO salary that Ali has to pay for. It's only one CTO, so we're not scaling that. It's just one. And then let's say that we have 5 senior developers that scale quarterly until that gets to, let's actually not scale them. Let's assume that this is a team that's already built. So 5 senior developers and 5 junior developers, just as a reference. So they're not scaling. We just have their salaries. They all have the same salary, just for a record. But what we have here in SG&A is, again, by adding that, we can now see that team being formed. Let's just check that it worked. Where we have here, the senior developers, the CTO, they should start in May. So let me fix that. Staff start these team members in May. There we go. Okay, so now, of course, our expenses have gone a lot higher. Now, in order to build this platform, we actually are short on money, right? If the platform only exists and sells, then we're good. But since we now have to build a team, this is a platform that eventually gets to profitability, right? So by year 7, it's making $11 million. It's costing $500,000 worth of server fees. The payroll is $3 million because we have the sales team and the engineering team. We still have HubSpot in there. And this is a company that's generating a healthy 67% EBITDA margin. So it's profitable. But right now, in May, there is a shortage of capital, right? We're $400,000 short. And then next year, we're $300,000 short. So this is the part for any company. This is the part of money that you have to raise, right? If you have to spend money to build something, this is looks like a healthy company. I believe Ali when he says that a sales agent is going to sell 10 seats a month. That number sounds reasonable and believable. But the question is, well, can this company get there, right? Can we reach that fundamental milestone? Because if we go to the monthly statement, we'll see that HubSpot's still here. Let's get rid of that. Actually, one useful thing and one little trick I'll show you. I added HubSpot just as a placeholder. Let's not. I'm friends with HubSpot. We make some videos for them. Let's just call this CRM. And then normally we'll need a certain number of seats for the sales team, right? So the CRM, the cost of the CRM is scaling based on the number of agents. So really, if we take the number of agents on the sales team and multiply that by 99 or 49, let's say, that's what usually CRMs cost, we're going to have a pretty exact number on the CRM, because if suddenly the sales team gets bigger, we'll be automatically accounting for the extra cost of CRM. So now that's a lot better. But anyway, here in monthly statements, we see that this company needs about $50,000 to scale every month, just the team that's building the platform, until it gets to revenue. So remember that what we were talking about on company stages. If you're a pre-seed stage company, which sounds like Ali is right now, he has a team, he's building a platform, but he hasn't launched yet. Sounds like this is a pre-seed company. You need to raise money to last until your seed round. So here it's very easy to see what's a seed round, right? A seed round is a company, again, that has launched already, that has a little bit of revenue, that's showing that there's interest in this product, and that it understands how to bring extra customers. I would say that when the company is here in February, this is a good seed stage. Like, this sounds like we've reached seed stage. We're growing fast. We have $25,000 worth of subscriptions, probably hundreds of clients by now, a formed team. So this is a point where the company could go and raise money again here. But we need to reach this milestone from the funding standpoint. And remember, here in February, this is when the company could raise money, but it doesn't mean that you go raise money and it happens in the same month, right? So here's where we could pitch seed investors. that got too long. We could pitch seed investors here in February, but then assuming that those rounds take a little bit of time to close, normally 6 months is a good reference. Let's say that, from February to July, like this is where we could actually raise a seed round. This is when we can assume that seed money will come in. So now all we really need to do, sounds easier said than done, is make sure that we're funded through July. And how much money do we need for that? Well, it's all here. Sounds like we were short about $800,000. So if we plug that in, and let's assuming that here in May, assuming that, obviously if Ali's spending this money, he's probably raised some money already, but let's say that here we have those $850,000. We'll call that round a pre-seed round. Let's assume that it's a convertible note. That's fine. And then notice that here we have a positive ending cash balance, and that cash balance lasts until our seed, right? Until July, where it's tight, right? We're left with only $15,000. So there's only a small reference, like a small ballpark or like room for mistakes. But yeah, so let's assume that in July, we can now go out and raise a seed round. That seed round could be a couple $1,000,000. We'll call that a seed round, and we'll add it as a price round, and then that we're funded again. And this company might not need money again, right? So after that, it doesn't like, well, it's still burning. If we look at the cash flow here, yeah. So this is the seed round, the pre-seed round that we raised. We're almost out of money. We have like just a little bit of money in the bank, but then that month we raise our seed, and then that covers the company for its continued growth. So that's the work. This is, in a nutshell, the work of the financial model. It's a little bit of trial and error, a little bit of, hey, okay, maybe we could say that maybe $850,000 as a pre-seed round. Well, maybe that's too much money. Maybe we can't raise that much. It requires we don't have the contacts. Realistically, we could raise only 800,000 or 500,000. Sorry, right. So that's more in line with your particular network, your investors, and so on. So what we see, we put that in is that we run out of money by January, and in January we only have $18,000 worth of revenue. So we could say that we're a seed stage, but we haven't added any cushion, any time for us to raise the round, right? So what do? We either raise more or we spend less, right? And that could be an option, right? We could say, well, yeah, so let's assume that the engineering team is a little smaller, making sure that we actually can stretch our revenue, can stretch our money to there. And it becomes a trial and error game, just playing around the numbers, going back and forth and seeing which combination of numbers works. And then as you start operating, as you raise around or as you hire a team, then this sort of becomes your budgeting thing, right? As you update it every month, you can see, oh, like we're on target, we're off target, we're going to run out of money here or not here. And that's why many times in my life, a financial model has sort of saved our company from oblivion, simply because we can look a little bit into the future and use our actual numbers, our realistic numbers, to estimate what's going to happen next. Okay, so we've built one. We've gone through the model map. I'm jumping into questions, just sharing my last conclusions. So yeah, questions, drop them in the chat, both for your live stream. I see a lot of people still in the live stream, so thanks a lot for tuning in. I know YouTube can be very pushy about getting you to watch something else. But yeah, I'll get to your questions. Just drop them in the chat. In the meantime, just 2 notes on how we can help. The best way we can help you guys do this on your own is with our bootcamp. So we have a financial modeling bootcamp that we run a few times a year. The next bootcamp is coming up next week, so literally starts a week from today. It's just a flat $199, and my team's going to paste that link in the description. Sorry, in the description, in the chat. Yeah, so think of this bootcamp as a week-long version of this webinar. It's all pre-recorded. You can go on rewatch. It has access to all of our templates. And then it includes 5 live sessions. So the way we structure this is we give you access to the pre-recorded materials. Each day sort of covers 1 lesson in everything I've gone through today in much more detail. And then we have a 1-hour live session where we actually go through your questions or build your models or help you brainstorm on the model maps that you're building, or help you solve complicated formulas. All of that we do during the live session. You can, yes, participate or not participate, all sessions will be recorded. You'll have access to the course perpetually. So that's generally the best way we can help. I think that, as I mentioned, like the only reason why our company has survived is because I had to learn to do this myself. I'm not a financial guy. I just had to learn to do it. And I'm trying to transfer some of this knowledge to other founders who are in the same place or where we were a few years ago. And then if you don't have the time or don't want to do it, don't want to do it yourself, and you want some more pro help, we actually have that as a service too. So our financial modeling services start at $199 a month, where our team takes over building your model, keeping it up to date with your expenses. So we talk to your accounting team to actually get your expenses every month, sync them up to the model, and show you a model that's up to date every single time. Plus the fact that you have access to our team to jump on calls and go over questions and build custom functionality or custom assumptions in your model. So that's the other part of it. Again, I start by trying to teach a founder to fish and help you guys through the bootcamp. And if you still need our help after that, then we have that too. Okay, I'll jump into questions now. We have like 10 minutes, so great. Cool. Let me stop sharing the screen and we'll where do I even stop sharing the screen? I lost. Where are you, Zoom? There you go. Oh, I wasn't sharing my screen. Oh, that sucks. Oh, my bad. Okay, I'll go back for it. I'll go back for a moment. Sorry. I had nice slides about this. I had nice slides for this. Okay, I'll show you the slides and then I'll jump into questions. Yeah, the two ways we could help: the bootcamp and the monthly subscription. Links pasted in the chat. Okay, let's jump to questions. I see the first question from Chris on YouTube. How do you include government grant and convertible debt in financial growth? Yeah, normally in that same line, I used to add funding, right? You could add a government grant. So government grant is an impact in your cash flow. So it's money that your company has. Normally, you won't have to pay it back. If it's a loan, it's a little different because we have a line for that for loans as well. But yeah, the model supports both of those pretty standard. By the way, the model has a huge knowledge base we've been working on creating. It has video tutorials for most of the sheets, documentation, how the formulas work. So we're trying to make it a little bit of like an operating system, if you will, long-term goal. But yeah, just add them as funding. It doesn't translate to equity. If it's a loan, if you have to pay it back, then use the loans section, the loans line. Okay. Chris again, how about China BRI soft loan? I don't know what the China BRI soft loan is, but if it's a loan, then it's treated as a loan generally in the model. So there's a line for that. How can you determine the CAC for a two-way marketplace? On a marketplace model, and we have a model map for that. You normally have two players, right? So let's think of Uber. Let's think of Uber Eats or DoorDash, which is I think a model that a lot of you are familiar with. There are two sides of that. One is restaurants, and then what's the way Uber acquires restaurants? At the very, very beginning, it was probably a sales thing, like a business development thing, where they would probably not even market, actually knock on doors or cold email or cold call or visit restaurants and offering them to sign up to the platform, right? It probably required that level of human touch. So that's a model that first becomes a sales thing, similar to what we just modeled, an outbound sales thing, and eventually becomes a marketing thing as Uber becomes large enough so that restaurants sign up on their own, right? And then on the other side, you have the acquisition cost for the customers, which are us ordering food every day. And the cost of acquisition of that could be a much more associated as a marketing cost, right? You have to do a certain number of ads. I don't know what the cost is, and you don't. I mean, if to answer your question on how you determine it, Jocelyn, it's the only way you determine it is by actually testing it out, right? So you go and say you run a small budget of ads, maybe $500 worth of ads, and with that you test and see how much is that cost of acquisition. Chances are it's probably going to be in the $100 to $200 range, I would say. Maybe it's a little bit lower, maybe it's in the 50-ish range. And then of course your question is, well, can you recover, or how long does it take you to recover the cost of signing that customer up? There's a good chance that you won't recover that in the first transaction, especially with a platform like that. I mean, I'm using Uber Eats as the example. What's an Uber Eats order? $20, $30. And a lot of that goes to the restaurant because paying for the food. So Uber's profit on that is maybe 10 or 5. So you need 5 orders or 10 orders in order to recover the cost of acquisition. But if the company can assume that that's going to happen, then the model eventually works out. But that's what you want. That's why you want to put it on a spreadsheet and see what happens. Okay, so taking questions from the Zoom webinar now. So I've seen companies, Ali, I've seen companies that have multiple pre-seed or seed rounds. Yeah, usually not a great sign. If a company has multiple pre-seed rounds or seed rounds, it usually means that they've misbudgeted at some point, right? They've assumed that they were going to get there and didn't. There's a common name like the post-seed round. I've seen this a lot. Post-seed round, which is what happens between seed and Series A. Usually, when you see a company raise the post-seed round, it's a bad sign, meaning that they run out of money before they reach Series A. And normally those rounds don't have great valuations. They're a bit of a desperate round in order to not lose the money that's been invested, but they didn't just hit their goals. So in an ideal startup story, you would see that transition from seed to pre-seed without rounds in the middle. Let's see what else. I see Thado. With organic driver like social media, has creating videos help peak sales in your experience? Yeah, I mean, videos, you guys are in a video. So literally videos are one of our marketing tactics. We think of video as an organic one where it doesn't cost us too much to host a webinar like this other than time. So we think of, there's obviously a team behind it. There's a YouTube team that's producing those videos. But again, the exposure that we get is not directly tied. We're not doubling our team in order to make double the amount of leads or double the amount of traffic. In theory, the same team could double that traffic if we just become better at making videos. But yeah, it's obviously the backbone of our business aside from SEO. I'll take Edson. So how do you set your metrics, KPIs, as you walk through the financial model? When do you know you're in trouble? I mean, you're in trouble if you're running out of money. That's the most obvious sign of trouble. But obviously keeping an eye on runway is key. There's a good chance, and I've seen this happen. I think that the model that we built today, Ali's model, worked really well because his subscription was $200 a month, right? So even though the sales team was expensive and we were assuming a $50,000 salary annual for the sales team, because they were able to bring $2,000 in value a month from their 10 conversions, and because those customers stuck around, it was a subscription, the math worked out. But I've seen companies try to do that, a sales-based approach, with a plan that's, say, $50 or $10, and that just doesn't work out, right? Because the math never works out. I'm actually going to show you that because it is a common error or a common mistake I see. I'm back screen sharing. Yes. Yeah. So if Ali's plan would have been $49 a month instead of the 200 that we added, there's a good chance that this business never made a profit, right? Because it gets to $2.7 million in revenue, but with expenses and SG&A, it always loses money. So this business is not viable if you only charge $49 a month. And I've seen a lot of founders that don't realize this, like literally don't realize this until it's too late, until they've launched already. In other cases, maybe you're charging 200, but the new customers per sales agent is 4 instead of 200. So this will probably break the business economics too. It doesn't break them, but it makes it much less profitable. So, or, just translating this into 2, if a single sales agent only sells 2 new deals every month, this business loses money every year. There's no way around it. You're doomed, right? So, it's very quickly as you go through the model, you're going to be able to see, which economics break. And, for example, the first month you launch, you actually get a sales agent, and that sales agent only brings 2. It's like, oh, this business will not work unless we change something. But this kind of like long-term, simple, but long-term forecasting helps solve or find a lot of those red flags in time. I'll take one from YouTube now. Let's see what I see. So Chris is 10% for $100 million is too much for hard tech. I heard a unicorn startup, but what's a dragon startup? Yeah, I think that valuations are pretty standard. Right, we have a whole webinar, and maybe I'll use this as a commercial. We have a whole webinar on how startup valuations work for fundraising. We're sending a follow-up email to everybody on the Zoom link, and we have one that talks a little bit about valuation. So I think that happens next week, if I'm not mistaken, along with the bootcamp. Last commercial. All right, guys, I've run out of time. I don't want to keep you, and I want to keep it up to the 1 hour. So I hope that this whole session was useful. Again, the extended version of this is our bootcamp next week, so I hope to see you all there. We try to keep the group rather small, so I don't think it's going to be over 40-ish people, and that way, the live session is going to be really productive, and I can get to answer all your questions. Plus, again, you get access to all the templates and all the materials that we've built. Again, thanks a lot for tuning in and sticking around for an hour of spreadsheeting, which I know is not the funniest thing to do, but a crucial one if you want to run a business. I'll see you guys on the next one. Bye.